bring in Barry Knapp, managing partner at Ironsides Macroeconomics. Barry, good afternoon to you. Thanks for joining us. What do you make of the PMI data this morning, and does that change how bearish you are in terms of the outlook?
No, it was confirmation of what we expected, and really where the fallout from the trade policy has really manifested itself. So if you consider the headline falling below the boom-bust line of 50, orders falling to 47-ish, employment falling to that level, and export orders all the way down around 43, this is a really just realization of the big mix shift in growth that's taken place over the last year. I mean, the thing that most economists and the Fed got completely wrong in 2018 was that the Tax Cuts and Jobs Act did create a supply-side shock. Consumption didn't move significantly higher, barely budged from the last 4-year trend rate of around 2.75%. But investment jumped to almost 6%, led by intellectual property investment, software, research and development. Even structures bounced for the first time after a 30-year downtrend. So this was really good news. It created a big surge in productivity, non-inflationary wage growth. We had labor market dynamism picking up. All these things were really, it was an excellent mix of growth. It's completely reversed, particularly in the second quarter. So growth is still running at 2.5%, but now it's being driven by consumption rather than investment, which has fallen back to the last 10-year trend of around 3.5%. And it may even be creating the inflationary impulse we're starting to see. The three-month rate of core PCED is up to the Fed's target of 2, undoubtedly why several of the regional presidents don't want to cut rates. The three-month rate of CPI annualized is at 2.8%, led by housing. So that's the one sector that had actually been exhibiting a Phillips curve this entire cycle. So, you're getting this deterioration of the mix of growth, and it's all because capital spending plans, business confidence surged in the aftermath of the Trump election, surged in the aftermath of TCJA, easy for me to say, and have now completely reversed the entire rally since the escalation of the trade war. So, to me, all of the good that was done on the supply side of the economy is at risk of being completely mitigated by the trade war.
Yeah, and Rebecca, I see you nodding your head a little bit.
Well, I would just add, Barry mentioned some of the indices in these business confidence surveys. I think those are so important to watch, not just for the headline number, but some of the subcomponents give you a leading indicator on the leading indicator, if you will. Like you mentioned, export orders as one example. The service sector data is what I'm watching the most closely right now because it's held up. To your point, the consumer is doing well right now. But what we saw for the month of August is if you look at the G3, so the 3 biggest developed economies, that service sector PMI, business confidence, fell to a 3-year low. And those leading indicators of that are also going down. So it's still positive. We're still seeing growth, but it does look like there's some early warning signs that it's getting pulled down as well. If that tips further, then the recession fears are going to be more and more justified.
Barry, just quickly, if you need protection, where do you get it from? If it's not going to be bonds because of the levels they are, what other asset classes or particular stocks you want?
Well, first of all, I mentioned in my pre-interview notes, gold and yen. Those are tough trades. I mean, I'm an old equity derivative person from the 90s. Vol is still not expensive here. Downside skew or the price for out-of-the-money puts is not expensive. To me, if the equity market were down 10% and those measures got extremely elevated, then we might get to a tradable bottom. But right now, you could still trade downside in S&P 500 options, buy VIX volatility, the VIX or VIX futures, VIX options. All of those things are reasonable from here. And I really don't believe that this risk-off event will be done until we get to significant extremes, the VIX at 30, for example.